So, hi everyone. Very warm welcome. Thanks for joining what I think is going to be a pretty interesting call, pretty timely call as well with the big news that's just come out. I'll go into that in a minute if you've not been following it. But to kick things off, we're talking about something I think a lot of founders, investors, and scale-ups are wrestling with, but they don't unpack necessarily as much as they should. What does it really take to scale a fintech in Africa? And I can't think of someone better to pose that question to and to dig into their journey than Charles Savage, CEO of Purple Group, founder of Easy Equities, someone that has been in the gig now for, well, 11 years with Easy Equities, I think 15 years, maybe more, since when you started originally with Purple Group and GT247. So we're looking forward to digging into that. I'd say up front, the Wi-Fi I'm at isn't great. I'm at a hotel just outside of London Heathrow. It's horrible weather, horrible Wi-Fi. Looking forward to getting back into South Africa, but we'll do our best. As always, this is really set up for you guys. If you've got questions, please post it in the chat. We'll do our best to get through as many as possible in the next sort of 50 to 60 minutes. So with that, Charles, welcome.
Thanks, Colin. Good to see you and be with you. I hope your internet holds up, and welcome, and thanks to everyone who's dropping in.
Yeah, I hope so too. If they don't, I'll WhatsApp you the questions and we'll just see how we get along. Let's just kick off for people, if there are people on the call that don't know Easy Equities. Can you just give us a quick summary of where you guys are at, now in terms of because I think you've turned a corner. I think, this last 12, 24 months, you've proved a lot of doubters wrong. You've had some incredible results. Maybe we'll just start there with an overview of the business.
Yeah, I think anybody who's been tracking us will know, but let's give a summary. I mean, our results were out in November last year, and I think for probably the first time, and maybe the second time, it's probably the second set of results that have durably evidenced our profitability, and also a shift in the scale and trajectory of the group. And, to summarize the things that really matter to us, we've got 90 billion in assets on platform, which is over the last 11 years has grown at 30%, compounded at 30% year on year, which is pretty remarkable when you consider we're dealing with retail customers and that's how they're growing their wealth. We service 1.2 million customers. And in the last financial year, we grew that active base by about 15%, which was, up above 11, 12% the year before, which is a good number, but there's still room to improve there. We serve our customers across a whole lot of verticals. So we're no longer just a one-stop shop for investments. So we serve South African markets, so you can invest in the JSE, but you can invest in Europe and the UK and US and Australia. And there's obviously a world of opportunities amongst those exchanges, and we'll keep extending them based on client demand. But we also serve our customers' needs in asset management, so you can buy mutual funds and unit trusts from us and ETFs. You can service your life insurance needs. We launched a life insurance business called Easy Protect, where we've underwritten the insight that investors make for better insurance clients. And what that means is that they have lower mortality risk, and we've patented that insight. And so if you're an investor and you evidence that behavior, then buying life insurance on the platform makes sense. We've also got a credit product, which is securitized credit. So you can get responsible leverage against your portfolio to deal with unexpected events in your life or planned events. So for example, a deposit in a house, education for your kids, or anything in between. And then we have a private markets platform, which currently services property and easy property. So you can get access to large scale residential and retail developments, as well as some other industrial developments more recently, where you can buy fractional access to these and build a portfolio across geographies. For now, it's all South Africa. Most of our concentration is across the country, with about 60% in Cape Town, but 40% around the rest of the country. We're about to do our first international raise, which is a retirement development in Mauritius. And so, nice and easy way for you to get access to private markets in a fractional, easy, low-cost way. That platform was developed to do more things in the private markets, specifically things like private equity and venture capital in time. And then our rails also allow you to move FX. We've also got a crypto business called Easy Crypto, which does essentially, gives you access to the world's most liquid crypto assets. And then today we launched our partnership into South African stablecoin called ZARU, which is, as people who are active in the space will understand, that the future of finance will be one along stablecoin rails. Fiat, this is probably Fiat's maybe not last decade, but one of its last decades. And in our view, it'll be replaced by stablecoin as it is being in other markets like America. And so we'll start, we'll participate across that. So, the business is at scale, growing fast, continues to innovate through new products and geographies. We have partnerships with some of the largest institutions in South Africa. We partnered with Sanlam, we partnered with Luno, we partnered with Discovery Bank, we partnered with Satrix and Telkom and Capitec. So we've got extraordinary rails for growth and new opportunities ahead of us. But that's kind of where we stand today. Mostly active just in South Africa, but we're open in beta in Kenya. So we are taking on known customers in Kenya, testing the platform and capability, and we'll go live to public probably in March. And then we're live in a sandbox in Philippines in partnership with GCash, the largest mobile wallet in Southeast Asia, to deliver US shares to their customer base. And that regulatory sandbox will probably continue for a year or so until such time as we get access to a full public release. So we're doing lots and have done a lot in the last decade. But in my view, we're in the scale-up phase rather than the startup phase.
You never worry about burning out. I mean, that's enough different products, different services, different geographies that most banks can't even cope up with. And you guys have got what, 250 staff. How do you keep up with all of this change and transformation?
Yeah, I think you've got to fundamentally hire the right teams, build the right culture, and then, if you like, create ABS braking systems for people who like to drive fast cars, so that when and if they crash, there's a safety system to limit the damage. It's akin to having trapeze artists and having a net below them. So and that fundamentally is, you have to enable the risk appetite in the group. You have to build a culture that is accepting of failure and enables a high degree of cadence for change, but also then to ensure that you provide the safety net so that no harm is done, either to a customer or to an employee or your partner. And that's easier said than done. You talked about my experience. I've been around this market. I've been doing fintech for 25 years. We built GT247, launched in 2000, was one of the first derivative stockbrokers in South Africa. We learned a lot in 2008 about the systems we didn't build and the safety mechanisms we didn't build. And I'm old enough to have lived through all of the cycles. And so, the benefit of experience means whilst you can have a high degree of optimism for the future, you still have to have respect for the past and what can occur and will occur, just uncertain when.
Can you give some examples of where you've broken things? Because a lot of CEOs will stand up and they'll talk about you've got to accept failure and mistakes are key for learning and providing safety and support and so on. And actually, when you go into the detail, they're empty words. They've just read them out of some Silicon Valley management book. But I think you've got real scars and real examples.
Yeah, I mean, over the last 25 years, we failed very publicly. I mean, GT247, 2008, we had customers in 44 countries across 44 exchanges. I took over as CEO in November 2007. And to give you some kind of financial indicator of what the group was worth, Purple share price at the time was R2. They just bought GT247. In February 14th, I'll never forget the day, because it was Valentine's Day, February 14th, 2008, we put the entire group into business administration. And the share price of the group at some point reached 9 cents. And we eventually recapitalized the South African business, but shut down all of the other operating entities. That's spectacular public failure, right? Through a listed company that we've emerged from. That's it, and it didn't happen quickly. I mean, it took us another 5 years before Easy Equities was born, and the idea and the concept. But it was through that extreme public failure that we built the resilience and the experiences for the next innovation and next decade. So that's probably the most spectacular failure that we've been through. But in smaller pockets, if you're going to innovate fast and build products fast, you have to build with the humility and understanding that your win ratio at best is going to be 3 or 4 out of 10. And so 5 or 6 or 7 of the ideas that you have, products that you build, will fail. And again, no harm's going to be done. But there is no predictor for what the future looks like. And what I mean by that is, if we could predict the future, then we'd only build the products that we knew would work in the future. But we don't have that. So for me, your strategy has to take a shotgun approach. It has to build the things that your customers need. So start with what those customer desire points are and needs are. But it doesn't mean that you're going to build them and meet that market need perfectly. And so we've had lots of products that haven't worked on the platform that aren't worth talking about. We always talk about the ones that have worked. But your product velocity and cadence has to be, in our case, build 10 products every decade. Try and be more successful than the last. So, last decade we scaled 4 businesses to profitability. In the next decade, let's see if we can scale more than 4, so that your success continues to stack into the future.
How do you keep your customers happy? I can imagine that with your fast releases, that there's been occasions where the releases haven't gone perfectly. It's caused some pain or frustration to the customer base. How do you keep those guys happy? Because obviously the feedback they give you is awesome. Testing on your customer base is the way forward, but it brings its issues too.
Yeah, we break things every day. I mean, and it's, I wish that wasn't the case. I wish that nothing broke. But the partnership we have with our customers is they have this very high expectation of what we will deliver in the future, not what we deliver today. And in having that expectation, there has to be mutual trust to say, cool, guys, you expect us to move faster. Therefore, you expect us to break things. So when we break things, we'll ensure that no harm is done. But understand that we're moving the group at a pace and a product velocity that means that we're going to drop the ball from time to time. And so be patient with us, highlight them, be vociferous around highlighting them so that we're aware and attentive and that we fix things quickly. But it has to be a relationship that is built on that mutual trust. That if you expect us to move fast and break things and meet all of your needs in a short period of time, that means at times things are going to break. And we are very aware of the things that we need to fix. And we've got high areas of focus and resource allocation to ensure we fix them. But at the same time, not while stopping our product innovation. We have to continue to move the business and its product set forward. Otherwise, our customers will be bored with us. Otherwise, you can go move your business to another bank or institution that is focused on stability and security and not product velocity or not innovation and growth. And so we've got to do both those things at once, which makes it really hard. But it fundamentally relies on a trusted customer relationship. And that's what we focus on.
You mentioned ZARU. Let's have a little chat about ZARU. Obviously, it's breaking news. I mean, 12 months or so back, I think you're on record saying that you're not specifically focused on stablecoin at the moment. You're not seeing opportunities. Here we are 12 months later, and you're part of a partnership with Luno and Sanlam and Lasaka, announcing the release of, I guess, the first really institutionally backed stablecoin in South Africa. Not the first stablecoin ever, but fantastic institutions backing it. How did this pivot happen?
For me, strategy is about playing the cards you're dealt. And so if you looked at the cards I had in January, stablecoin wouldn't have been, in my hand. And then having a high awareness of the cards that are being dealt. And then you just go fast forward to April, where, Trump starts to propagate regulation that supports crypto in at a pace and speed that no one predicted. No one predicted. And so now suddenly there's new cards on the table, and you can either choose to ignore it or you can embrace it. And we chose to embrace it. I mean, our head of crypto, Earl Loxton, I sat down with him and said, what does this mean for us? How do we participate if we fundamentally believe that the future of fiat is going to be delivered, or future of currency is going to be delivered on stablecoin rails? What is the best way to go about it? And we believed it was in partnership. And so I gave him the mandate to say, let's go and build the best possible partnership. Let's find out who sees the world the same way that we do, and see if we can partner those ambitions. And, it's an old adage and overused, but where can we find 1 + 1 is more than 2? In this case, it was 1 + 1 + 1 + 1. The outcome isn't going to be 4 here. The outcome is probably going to be 40. So, that's part of how I like to, 80% of what we do is typically planned, and the plans don't change. But 20% of what we do is really just watching the table and making sure that your hand responds to the cards that are dealt. And stablecoin was dealt last year, and so we had to respond. And within 6 months, we managed to identify the partners that were building credible businesses or had similar strategies to build credible businesses we do, and we partnered those ambitions. And I'm very proud to say we're part of that founding partnership that was announced today.
Those that don't know, how does stablecoin actually work, and how is it different to Bitcoin? I think it's important to cover that first before leading into where you see the value and the opportunity is.
Yeah, look, I think fundamentally the key difference is it obviously runs on exactly the same technology set as Bitcoin does. So I don't want to get into technology debate, but it's backed by the currency that it purports to be a stablecoin of. So, the reserves behind ZARU are going to be rands and fixed income instruments in the same way that they are the reserves that sit behind a bank's balance sheet, or if you like, behind your cash at a bank. So it is completely covered by those reserves. And that's exactly what Standard Bank's role in and the auditor's role in confirming those reserves, and Sanlam's role is to ensure that for every rand of ZARU that is issued, 1 rand equivalent is held in custody and secured. But what does it achieve as a result of the technology that it's built on? Fundamentally is faster, cheaper settlement. That's the business case. Fiat, as we know, even digital fiat, tends to move relatively slowly. It has tended to real time. Payments. South Africa, in fact, has got a very strong payments ecosystem where you can get real time payments. But the de facto modus for operating for stablecoin is real time. So it's not. It is its DNA. It's how it operates. And so if you think about what does that mean in my space, what does that mean for capital markets? So capital markets today, markets settle T+1 to T+3, depending on which markets you're investing in. Cash moves between banks, T+1 to T+3 on a week. And what I mean there is settlement doesn't happen on a Saturday and Sunday. It happens, on a Friday and a Monday. So sometimes it's T+1. What stablecoin allows capital markets to do is to eliminate that delay, that time, and to ensure that the foundational layer of everything, which is money, moves at the fastest possible rate at the lowest cost. And that sets the foundational layer, which for me signals that the future of finance is going to be tokenized. And so, we believe that ETFs, that all instruments, every single financial instrument that we consume today, from shares to unit trust to ETFs, to property, to everything, will fundamentally be tokenized. But it will only be tokenized once we successfully tokenize and adopt stablecoin, which is the first leg to this.
So my internet's a bit unstable, but the part that I wanted to get into was the regulation side of things. The technology allows instant payment. In theory, we can do cross-border. We're in the States, we want to go and remit money to South Africa or vice versa. You're a corporate, let's say. You can avoid the banking, system. I remember an interview with Deal from a few years ago, a massive organization that is obviously already using stablecoin to move money around the world to go and pay staff which are using their service. So it sounds fantastic, but as with all these things, it's usually not the tech that gets in the way, it's the regulation.
Yeah, look, South Africa's created a very strong, not quite first mover approach, but a very strong regulatory framework under which crypto can operate. The legislative framework is broad, and what I mean by that is that they've chosen to regulate fast, but they haven't They haven't defined the disciplines, the various disciplines that crypto is going to end up doing very well. And they've placed a lot of trust in these CASP licensed or crypto regulated businesses, and they're monitoring it very closely. And so the regulation, for the first time, certainly in my career, has taken a follow approach. It's looking to see where traction is going to occur, and then it's fast following with supportive regulation to ensure that it embraces this innovation and this change. And so it's very positive to see how South African regulators are responding to this fast-paced regulatory change. US is setting the pace, which is not abnormal for them. And the rest of the world is trying to kind of keep pace with it. And I think South Africa is moving in the right direction and setting the right regulatory frameworks for this adoption to have no excuses around regulation.
Do you see this actually becoming a proper currency and there in terms of a currency we can use on a day-to-day basis? There's lots of different uses for currencies. Obviously, everyone started with Bitcoin. A lot of people thought that this would become a transactional currency. It's not turned out that way. It's still too expensive, too slow. There's other issues. It's too volatile. This doesn't have volatility. We're backing it to the rand. Do you see this becoming something that we're going to tap with point of sale and soft POS? We're going to be doing digital transactions when we go into the local shops or buying our stuff from Amazon online?
100%. I mean, that is the business case. Create a trusted store of value, and then ensure that it's interoperability across payment systems, I saw a question across other stable coins, across point of sales, across the entire financial ecosystem is then plumbed. That doesn't happen. But that is the business case, is that over time it will displace, it'll be available to you wherever you need it to be, whether that's buying a car or paying for coffee or settling a transaction, settling an equity transaction or purchasing a home. And so in the end state, that's where it'll be. Where it starts will be where it serves the greatest needs and solves the biggest problems. And one of those, as an example, is remittance. Remittance, the spreads on remittance are just so high. And what that means, people pay a lot to move money from one country to another. Stablecoin solves that very efficiently and very effectively, lowers the cost, increases the speed, certainty, trust, and transparency of those transactions. And so, like anything, it will be adopted where it solves the biggest need fastest. And those business cases will be the ones that lead the adoption of ZARU. And if you look at our partners, if we just pick on Lasaka or highlight Lasaka and picking on them, they've got something like 100 or 130,000 merchants. They've got to be sitting there thinking, what a wonderful opportunity to streamline those rails, to adopt stablecoin in time when it's ready across those channels.
Yeah, so the transfer mechanism is cheap, but the on-ramps and the off-ramps can be expensive or non-existent. We go and move using this platform, I don't know, money to Egypt. I'm sitting in Egypt. How do I go and convert this and get an off-ramp so I can go and convert that back into my local currency or dollar? How do you see that panning out?
Yeah, I mean, the partnership network that will be built. I mean, to start with, there's just 4 of us, but that's, if you've looked at the press release, the invitation is to other institutions to partner in this network and to create a network where these on-ramps and off-ramps can be democratized. So everywhere, to partner banks and institutions, to partner mobile wallets, anywhere that these cash on-ramps and off-ramps can reduce the friction for people to participate. And so that the invitation is open for institutions to join us to make sure that these on-ramps and off-ramps scale fast, that there's an incentive to do that, and so that in the end result, customers can benefit from the efficiencies that are created, and that you don't have, the costs are not undone, or the efficiencies are not undone because the on-ramps are too expensive or too limited to or exclusive.
Christopher's question, what are your concerns about weaknesses in this? How do you go and, for example, make sure you're auditing what's actually occurring? It's not perfect. Let's put it like this. You are in the early days.
Yeah, listen, the way this is set up is that the reserves will be audited. Institutions of large scale and credibility and done this liability asset matching, in their sleep. And so the partners that come together have all got a slightly different role to play in bringing their IP to bear and experience and balance sheet. And so, the role of the auditors, the role of Standard Bank, and the role of Sanlam in this partnership are very clearly in those areas. Our role as Easy Equities is in the capital markets experience, retail distribution, investing, etc. And so I think when you put the four role players together and the other partners that will certainly come, the roles become more clearly defined, and also more aggregated, in that you have more participants looking after each of those areas.
How do you see the consolidation happening on this, Charles? Because, obviously now we go into a shop and we tap, I mean, we pay in rand. So it's nice and simple. Might be Visa, might be MasterCard, might be Bank ABC. There's a lot happening in the background, but from the customer experience, it's rand. And we don't see the charges necessarily that are happening as it's going through switching and the rails and so on and so on. Here, this is a bit different because, anyone can set up a stablecoin if they can find someone that's going to run the back end services, the hedge and buy the treasuries and the money market funds, and find ways to go and deliver these particular tokens or transactions. How do you see this, therefore, panning out? Do we end up with just a race to one, where there's a single provider? Are we going to have multi providers, and then the currencies are slightly different?
Yeah, look, Colin, it's hard to predict what the future will look like. But if you just look at South Africa, there's probably room for two or three to own, and those two or three will own probably 80% of the outcomes. And then there'll probably be 100 others that own the other 20%. And so, that's probably what the market will look like. Those who win will be those that create the highest value proposition and solve the biggest problems fastest, and have the highest credibility and trust in what they're doing, because fundamentally this is people's money and that matters. So trust is big. So, that's how I see it playing out. But if I was any good at predicting the future, I'd just buy stocks. And so I don't. I try and build businesses.
Yeah. Where would you put this in your kind of 1 in 10 bets? Are you excited about this one, or are you just keeping a level head and just saying it's just another bet, another product you're trying, and you'll see what happens?
No, listen, I couldn't be more excited about the future of tokenization, starting with stablecoin. It's why we bought Easy Crypto, almost 5 years ago, is that they came with crypto market experience, but also tokenization experience. So I fundamentally believe that the future of capital markets investing is going to be one on crypto rails, and it starts by scaling stablecoin. So I'm exceptionally excited about this, and privileged to find ourselves in the company of those partners. Little Easy Equities up with Sanlam, Luno, and Lasaka. And so, I'm very excited about it. The future may come faster than we expect, but also may come slower. Again, if you just go back 12 months, did anyone expect stablecoin adoption to be what it is today 12 months ago? No one. Not even the leaders, the business leaders in stablecoin predicted this acceleration. And so, I'm super excited about what it can do. I am cautious about how fast it will be adopted, but excited about what the next decade will look like.
Lots of questions coming in, which is not surprising on stablecoin. We'll try to go through some of these as quickly as possible and then move on to some of the other topics. But Peter's got a question on tax. I'm sure you can see it. I'm not sure that you want to answer that one. Otto's question, I think you've kind of answered. Do you see ZARU as a payment method that will be widely used by micro merchants, something like M-Pesa?
Yeah, I mean, 100%. Again, it's hard to predict where the early adoption will find itself. It will go to where the biggest problems are, and where it can solve those with the greatest efficiency. And whether is that going to be micropayments in phase one? I don't know. I think it's hard to predict where the early adoption is going to come from. So I don't have all the answers. It's much easier to predict what the next decade might look like. It's much harder to try and identify what's going to drive that in the next 12 or 24 months.
What do you think the biggest blockers to success from Heidi? What will the biggest blockers likely be?
Adoption, trust, integrity, efficiency, and scale. The first coin that gets there. That, whoever has the highest trust, the highest level of distribution, delivers it with the highest integrity, I think wins. And there's a lot of horses in the race. I mean, I think at last look, there are at least 5 or 6 very credible stablecoin competitors out there, all with the same ambitions as we've got, and all highly credible. But it's the one that builds, the most trusted brand with the highest level of integrity, with the most access on ramps and off ramps and most digital use cases, that in my mind wins.
All right. Look, if everyone's got more questions, keep posting them through. I'm sure we can ask Charles or one of his team to give us some answers back. I'm sure there's going to be lots of statements on this over the coming days. Just want to round it out, though, with an observation about one of the reasons it seems that you've been incredibly successful is your ability to partner with organizations. I mean, for I think a stroke of genius for Easy Equities to sit there and say, let's try to go and deal with Discovery, or let's go and offer our products and services through to Capitec and other organizations. So you've got that track record of partnership. How did you come across and organize the partnerships that you've got here with Luno and Sanlam and Lasaka? Picking the right partners is obviously very important for this to work.
Yeah, look, I think partnership is in our DNA. I mean, and when we built Easy Equities, you've got to realize, what do you bring to the table versus what you've left off the table. And if you just look at the purple group, at the time it was balance sheet deficient. It had a lesser known brand. It was hardly known at all. It had an income statement that was incapable of funding its own growth, but it had a really good idea in Easy Equities to democratize access to all things investing. But in understanding those deficiencies and having a high degree of humility around them, you then go, well, how do we solve these? What's the most efficient way to solve these? And the most efficient way to solve it, in our view, was to partner. If we've got a great idea, then build a great platform. And if it's as great as you think it is, then you will be able to solve those deficiencies by partnering with institutions who've got balance sheet, who've got brand, etc. And so right from the start, we knew what our strengths and weaknesses were, and we partnered our weaknesses. And that has been our secret to success. One of our secrets to success has been the humility with which we approach partners. They are much better at what they do than we are. And we have something that solves a problem for them. So solve it for them. And that's the same approach we took here with this ZARU partnership. We play a very small but critical part in the ecosystem. But there would be, if we try to do this alone, we would have all of the deficiencies that Luno, Lasaka, and Sanlam solve for. We can't pretend, purport to, or have the arrogance to say that we can do all of those things. And so I think partnership is won by a deep understanding of what you can't do or what you're not good at doing, and then the humility to go and seek those partners out and create an environment where everyone can win.
Yeah, lovely. A slight sort of pivot on my side now. Ian's opened up an opportunity there to talk about the R1,000 for kids. I mean, clearly, if we look back at, I think you've been consistent from day one, this idea about democratizing access to investment opportunities, firstly in South Africa and then across emerging markets in general. And you've been pretty consistent there with the products that you've released, for example, fractional investing into housing stock. Opening up opportunities to get into crypto, obviously the equities market, giving people access to international equities markets. There is a theme that runs through it, even though they are quite different products from time to time. What is your role in trying to democratize knowledge about investing, especially through to those younger generations?
Yeah, so I mean, firstly, we run a very, very effective and scaled education platform, which is aligned with our loyalty program called Thrive. And essentially, there's an incentive for you to get educated. Every month, we'll publish a new course. They typically take between 10 and 15 minutes to do. They're bite-sized chunks, and a 10-year-old would have no difficulty to read, consume it, and answer the questions. And we're all 10-year-olds when it comes to investing. That's the truth of it. And so again, it's about delivering the education that meets our market where they are. And so, 10 years, 11 years later, there are hundreds of courses, bite-sized chunks of that deal with everything from just using the platform to things like diversification, to valuations, to even pitching up and expressing your vote at a share at an AGM. So we've got a scaled digital platform, and that is part of our platform ecosystem. But more specifically for kids, you can't reach a toddler, you can't reach a newborn child. And so the access point is the parents, to educate the kids that the greatest investment or the greatest enabler of investments isn't what you buy, it's when you buy it, it's time. And fundamentally that, therefore we should start at day zero. The first thing you should do for your newborn kid is put 1,000 Rand into a tax-free savings account. And South Africa has got a wonderful structure. Tax-free savings, in my view, are the greatest gift government has given us in the last decade. They really are a wonderful structure for low-cost investing. And the tax benefits are very, very tangible and real. The only thing that I think the only addition I would like to make to it, and we've come up with this concept of giving every South African, every newborn 1,000 Rand, which really is just a copycat of what the US is doing. But the difference that we've asked government to consider is to say there needs to be a tax incentive for this. There currently don't any contributions to a tax-free savings account is post-tax. There's no tax incentive. And I think if the right tax incentives were in place, one, more parents would do it, and two, especially private institutions and more philanthropy would happen. So we would see, which is what has happened in the US. We've seen huge philanthropy. I think Dell gave $1 billion to the kids of their employees to fund these accounts. So the tax structure in South Africa just needs to be slightly rewritten to enable the ability for investments like this to get to scale. But from an education perspective, all of the tools are already in place. And the accelerants for those tools, AI specifically, are also making sure that education is moving at a pace that I haven't seen it before. Financial literacy partnered with AI is a massive opportunity and accelerant for education and investing.
Are you making progress? Do you think that next 12, next 24 months we'll likely see some sort of government initiative to try to go and do 1,000 Rand per child per year?
I don't think, I don't, like, I'm an optimist. That's hard for me to say. I don't think so. I just don't know. I think the key is there are no excuses to do this ourselves. And what I mean by that is there's no reason why.
Is it, Charles? I think perhaps a better way to go and see this is what support do you need from us on the call and others out there in terms of advocacy and community to try to go and, get a bit of a movement behind this? It feels like the more voices ask for it, the more likely we are to get it.
Yeah, that's exactly right. I think you have to raise your voice internally at the institutions that you work at to say, guys, this is a good initiative. This would do well. And to get those business leaders to raise their voices and communities to raise their voices. It's the journalists have responded well. There's been some media attention and interest, but we can't let that dissipate. We want it to be something that one of the political parties kind of adopts and says, well, this is something we'd like to do, because I do think that it'll win votes. And I have little interest in politics, but I do think that if you look at what the outcomes of this could create, I would think that a political party who listens and takes notice could probably win votes as a result of supporting this.
Mm. Let's talk about funding. It's something I've always wanted to ask you about because I think Easy Equities is a little bit different and sets a different model for other startups and scale-ups in terms of how you funded the business. I mean, for many years you've been loss-making. I think the last year or two it's turned. You're now scaling. Your jaws have improved, so that cost to serve is kind of reducing, margins increasing. All the signals are looking really, really good. Maybe you've reached that tipping point where someone says you're actually running a mature business now. I'm not 100% sure you'd agree, but it's just an incredible journey. But through those loss-making years where you needed, capital investment for the marketing and to build these products and services, you needed people to back the risk. It wasn't obvious it was going to work. most of the other fintechs are going down the private route, you know, whereas you right from the start were really listed and public. Can you talk a little bit about that and the kind of, the benefits and the costs that's brought to you as an organization?
Yeah, look, Easy Equities was born inside the Purple Group. And so it made sense that it stayed inside the Purple Group. It didn't make sense to take it private at that point. And we thought little about where it should be, whether it'd be better to be in the public or private space. In fact, we paid no attention to it. It was just where we were. And the backers for the original idea were Mark Barnes and Ronnie Lovener, who were the two strongest board members, strongest in terms of their voice and shareholding. And they supported the idea, and so it found itself in the Purple Group. Subsequent to that, we've actually run a combination of private and public market funding. So if very early on, we partnered Satrix, and that led us to Sanlam, and Sanlam's review or interest in the business grew to the point where they wanted to participate. But they participated in a private way. So they bought 30% of Easy Equities at a subsidiary level, not at the holdco Purple Group level. So if you like, in that instance, we raised private capital. So 30% of Easy Equities was bought for 100 million rand, I think 7 or 8 years ago now, by Sanlam. And that 100 million rand was 100% of the capital we thought we required at the time to get us to scale. And that didn't turn out to be the case. We ended up raising another 100 million rand in July, it'll be 2 years ago, where we thought we would need another 100 million to get the business to scale and profitability. And interestingly, again, we were wrong. And this time we didn't need the 100 million. Last time we needed more. This time I think the drawdown, we got to about 80 million on it. And then the business started to work much better at scale. And scale came faster than we anticipated. So we're highly profitable and now self-funding. And so the requirement to raise capital has changed over time. It's not a perfect science. We've used private market access where it made sense, but public market access where it's also made sense. The difficulty of running a startup in the listed space is you're constantly in public review. Your decisions are reviewed every 6 months. And anyone who's built a startup knows that 6 months is just a flash in the pan. You can't, it's an unfair period to review business progress, but it does create a discipline that with hindsight prepares you for a much more mature organization. You've constantly got to equate effort versus impact. You've got to consider resource allocation versus profitability. And so you end up running in a much scarcer environment, I think, with much more urgency than what you would do if you were hidden behind a private veil. And so I think it's created really good disciplines in the group in terms of efficiency and scale. But at the other side of it, there have been times where I just went, look, this income statement, last financials, we delivered about 100 million rand of free cash flow in the group. And I just wonder how much faster we could grow if we were capable of redeploying that. And if we're a private company, the choice would be simple. You just go, your return on capital is high, invested in the business. As a listed South African entity, there is little appetite for that. South African investors aren't your American growth investors. They want a balance of both. They want growth and return, i.e. profitability. And so we've built the business, I think, in possibly the hardest way. High degree of public transparency, scarcity of resources, and constantly balancing, investment in growth and delivery of returns for shareholders. So it's been tough, but it's built good disciplines.
What would you advise for the guys that are scaling up here? Would you advise they steer clear of listed markets for as long as possible? And is it different, I suppose, to how you see the US? You opened up with the US. I mean, let's take OpenAI. I mean, one of the fastest growing, most valuable companies in the world, which really the access is limited to just a chosen couple of hundred super wealthy guys and VCs, which isn't particularly democratic or fair. Many would have liked to have been able to invest into it. So there's kind of two angles to this. One as the startup, the founder, what you'd recommend in terms of the funding, and then two for the general public, this idea of democratizing, where we try to make sure we serve those guys.
There can't be a one-size-fits-all answer to this. The one thing I left out in being publicly listed is that our shareholders become a force for change, a force for marketing, a force for the group. And and to give some kind of credence to that, when prior to Easy Equities, Purple Group had less than 1,000 shareholders. Today, somewhere near 150,000 shareholders. What does that mean? It means you've got 150,000 warriors out there defending your business and your brand and sharing ideas and pitching up at your AGM. And that's a very powerful force that you can't get in the private markets for the reasons that you stated. It's typically small groups of very strong shareholders. So it really depends on what you're building. And the other thing is that as South Africans, we can't be too discerning about where the capital is going to come from. In the private markets, they tend to come from the same 10 places. And if you've exhausted those and there's no interest, then you're going to have to look elsewhere for capital. So I don't think it's horses for courses, but also you've got to go where the capital is going to find you easiest. And so sometimes it's a blend of both. And in the case of us, it was a blend of both. Raising money in South Africa is tough, but it's not unnecessarily tough. The generation of ideas is very good. We come up with really good ideas, but the scarcity of capital is very high, which just means less deals get funded than any of us would like. In America, it's very different. You've got a high level of generation of ideas, but then you've also got a massive availability of capital, and so more ideas get funded, which means they tend to have better, more successful outcomes. Because in venture capital, it's also true, 1 or 2 work and 8 don't. And so if you want to scale your an ecosystem for startup, you've got to be taking hundreds, thousands of bets every year. And in South Africa, we just don't have the capital structures to allow that to happen. There's no shortage of skills, of talent or ideas, but there is a capital scarcity. And so you're going to have to go where you can source that capital best. And sometimes that's public and sometimes that's private.
In fact, the US has definitely got an appetite for risk, hasn't it? I think the multiples for is it Tesla at the moment is kind of 400, which is just insane. 400 years of earnings and you get your money back for your investment. That just seems completely balmy. But you're quite high as well compared to other stocks, aren't you? 40 or 50, but you're obviously expecting that to come down.
Yeah, look, it's what has happened in the group is that we've gone beyond our high watermark on costs, and now that leverage over our cost base is starting to show in the income statement. And really what that means simply is that a high proportion of our income now falls to our bottom line, which means that we can depreciate that multiple much faster now. And so people are betting that our income will continue to scale at a higher rate, but a bigger portion of that income is going to flow to our bottom line. And that was evidenced in last year's financials. And so whilst with the benefit of hindsight, you look at the PE, which is a measure of hindsight, it looks expensive. But if you have some foresight and you look at it and say, well, what additional revenue will they produce this year or next year or the year after, and what percentage will flow to the bottom line, that PE might look quite compressed.
So one of the bets that people might be making in terms of that foresight is the impact of AI. Let's dig into that, because if there's anyone that's going to have views on this, it's you. If I was asking CEOs from larger listed entities, I might not be getting very exciting answers. But when you think about AI, I guess there's different angles. There's how you use it in terms of what you build. It'd be interesting to get an update in terms of how you're using it. There's how you're developing products and services for your existing customer bases, and seeing what they can do. And then there's just, there's crazy thoughts in terms of how this completely transforms whole markets, maybe even the equities that people invest in. Let's start with the easy thing. How are you using AI internally for your build processes?
Yeah, I'm not going to answer your question. I'm going to just give you a thesis on AI, and then I'll answer your question. But my conviction around AI is very high. And if you just look at the last decade or so, the businesses that have scaled have largely taken old world business models and provided a new user experience, and really eliminated friction through that user experience. That's been the accelerant. It's just and the most obvious or best example of that is the iPhone, is smartphones. If you just remember what the old, dumb phones were like versus the smartphones, which is a much better, it fundamentally did the same thing, much better, and then layered on a whole lot of other things it could do, and created incredible outcomes. And in the last decade, other businesses have leveraged that capability. And in our case, that's all we've done. Nothing we do, an investor couldn't do a decade ago. They just couldn't do it in one place as easily at the same price that we do it for. I think the next decade will be won by those who lead with AI, that solve customer problems and business problems AI first. And so I think the accelerant for the next decade is no longer UI or UX. It's AI, and the future operating system for everything we do, and I mean everything we do, will be AI led. Whether that's creating a will, a financial plan, investing in stocks, moving money between a bank account and somewhere else, buying your next holiday, detecting fraud in your business, reconciliating your cash flow, assisting your auditors, and everything in between. For the next decade, the rush is on to make sure that that's AI led. And so for us, the way that we're adopting AI is to say, how do we lead with AI in everything that we do? We're not trying to keep it at certain verticals of the group. We're trying to ensure that we're doing it across the group, and everything we do that is new must be AI led. So if you're looking at a fraud detection system, or if you're looking at a legal contract system, that must be AI first. If we're looking at driving products, building products, we must be building it with AI tools. And then to measure the impact and ROI, I think fundamentally, or to give some views on the impact and ROI, I think fundamentally AI does this. It's an accelerant on the return of human capital. So let's just say that the return on human capital today is one to one. You get 100% return on the human capital. So if you invest in somebody in your company, you get 100% return. Let's just use that as a measure. The evidence for us is that that same human partnered with AI is 2 to 3 times more effective in their work and their job environment. So the ROI is 2 to 3 times higher. So for a business like ours, the opportunity is we have 250 staff. Can we get an ROI that equals 750 staff using AI? Yes. And that's the journey we're on, is to make sure that we enable that and create an environment where we can get a 2 to 3 times return on our staff by just partnering AI, so that we don't have to be a 750-person organization. That's our opportunity. The opportunity for large corporates, and we're starting to see it now, Amazon, Google, and others, they don't need the additional human capital. They're actually looking to reduce the human capital, and so you're starting to see them let go of staff. So theirs is very different. Ours is an accelerant on the return of our human capital, so that we could do more with less. Theirs is to do more with less, in the sense that they can get rid of staff. And so I think you're going to have these converging strategies, or five strategies. One, where companies like ours that are growth orientated and have huge opportunities in front of us, is used as an accelerant to get more return. There's others, large institutions, that are going to look at it and say, well, if we can get rid of 20% of our staff base, we can deliver an 8% return on investment to shareholders in 1 year, whatever the number is. And so that's the way we think about it. It's just, how can we use it as an accelerant for our business? How do we turn 250 staff into 750 in the next 12 months or next 24 months? And the key kind of enabler is that the truth is that 12 months from now, it's not going to be 3x. It's moving so fast that 12 months from now, it might be 10x. If you look at things that Elon's saying and the leaders in AI are saying, is they're seeing 100x displacement. And so, but for us, the opportunity is not to cull staff, is not to get rid of anyone, but rather partner AI and accelerate our adoption of it, so that we get a higher ROI out of humans, so that we can keep them and reward them more.
Let's just get your view on how impactful you think AI will actually be. So, and maybe these are yes, no answers to start with. Do you imagine in the next 12, 24 months that virtually all of your code will be written by AI?
24 months, high probability, 12 months, 40 to 60% minimum.
And then the second kind of yes no is when you look at your client base. I don't know if it's quite that quick. Clients sometimes take a bit longer to move. Do you expect that it's going to be more agentic agents, or maybe what year would you expect it's more agentic agents that are interfacing with your easy equities rather than humans through your website?
Yeah, so certainly in the next 3 months, our customer engagement strategy will be agentic driven. We've trialed and tested various technologies. We think we've chosen the right one, and that's going to be a massive accelerant in making sure our customers get served faster, better. And so I expect within the next 3 months that will be the case. And then the customer interface, in my view, will move towards agentic to the extent that you can solve problems faster than humans can at a lower cost. So as an example, I don't take an example where I think AI would radically improve the interface for me, and that's something simple like a will. It's a process that is currently human-led. It requires not that much intelligence, but it's also a process that gives up information that is not that comfortable to share. Your assets, who you're giving them to, etc., where they reside, things like which aren't included, but things that should be included, like where's the money, what are the passwords to the money, what are the things that I need to stop doing if you die, all that kind of stuff. And as you when someone pays some real attention to that and uses AI, it can solve all of that way better than humans can, with a high degree of privacy that is on site, i.e. it's only with you, and not shared with somebody else. So I fundamentally think that the adoption of AI for customers is going to exceed expectations. I think it's going to radically transform the financial services landscape in the next 12, 24, and 36 months. And it's going to leave no area of financial services untouched. And what I mean by that is, there are parts of the financial ecosystem that are untouched by technology. I mean, look at asset management as an example. It's the same as it was 100 years ago. Slightly more efficient, slightly more effective than it was potentially, slightly more enriched by technology. I think AI disrupts it radically. I think, and again, there's examples of this. I think it was Goldman's who came out and said 14,000 or 400 analysts have lost their jobs to AI. Well, that's not going to be long when those same analysts that line up the asset managers aren't going to be out of jobs because they're displaced by AI. So I think it is the greatest accelerant, the greatest technology, the greatest innovation of our time. I'm looking at you and me, Colin, because we're of similar age. I'm more excited about AI than I was about the internet back in 2000, about smartphones in 2004, about the advances in blockchain technology 2012 and 2013. I think this is it. I think this we will reflect on this in 20, 30 years and say that AI was the greatest innovation of the last 100 years.
Charles, I think that's a good point to end it. Thank you very much for your time. I really appreciate it, especially knowing how busy you are. Thank you very much for making the time. Also, want to thank the sponsors, Silicon Overdrive and Amazon Web Services. Without those guys backing this, we wouldn't be doing these interviews. So whether you loved it or hate it, you can effectively blame those guys because it's their fault that we're setting up these discussions. So thank you very much, guys. Finally, just to everyone that dialed in, thank you very much. I know we didn't get through every question. I've got loads of questions I'd like to have asked as well. But thank you very much for your time. Thanks for your feedback. Have an awesome, awesome day, and we'll chat to you all soon. Thank you very much.